This is what happens when a single fabricated story exploits real market chaos to go viral across the internet. Late December 2025 saw claims explode across social media that JP Morgan had posted a $4.8 billion loss in silver trading and that the Federal Reserve had called an emergency meeting to address the crisis. Within hours, the story spread through Twitter, Reddit's Wall Street Silver community, and dozens of precious metals websites. But here's the thing, none of it was true. What makes this story worth examining is how the bankruptcy claims gained traction by exploiting genuine, extraordinary conditions happening in silver markets right now. Silver prices have surged over 120% in 2025, breaking records that stood for 45 years, while supply deficits have persisted for 5 consecutive years. JP Morgan does have a documented history of precious metals manipulation that cost them nearly $1 billion in fines. The fabrication worked because it was grafted onto reality. So what actually happened? How do you separate the signal from the noise when conspiracy theories collide with legitimate market volatility? What does this reveal about how misinformation spreads in financial markets? Let's break down the facts. The weekend of December 27th and 28th, 2025 marked when the story began circulating. The claims arrived with specific and alarming details. JP Morgan had supposedly disclosed a $4.8 to $4.9 billion loss on silver positions in an SEC filing. And this loss was so catastrophic that the Federal Reserve had called an emergency meeting, something the Fed only does during genuine financial crises. Some versions claimed the bank had already collapsed at 2:47 a.m. on Sunday morning. Precious metals enthusiasts on Twitter began sharing screenshots and urgent warnings, and the story spread like wildfire through predictable channels. Reddit's Wall Street Silver community, which has over 200,000 members focused on silver investing, amplified the claims while various silver-promoting websites published breathless articles about the impending collapse, many of which profit from increased interest in precious metals. Thin holiday trading, when official channels respond slowly, created perfect timing for viral spread. Market participants were already on edge from legitimate silver market volatility, and the claims exploited real facts about JP Morgan's past to seem plausible. When you actually investigate these claims, they fall apart completely. Where this story originated matters, and that's where alarm bells should immediately start ringing. A man named Hal Turner, who operates the Hal Turner radio show, served as the primary source. According to Media Bias Fact Check and multiple credibility assessors, Turner's website promotes extreme right-wing propaganda, conspiracy theories, and hate, with very low factual reporting. But the story gets worse than just unreliability. Turner served 33 months in federal prison in 2010 for threatening federal judges, and he previously worked as an FBI informant in a role described as an agent provocateur, someone who provokes others into illegal acts. PolitiFact has rated multiple Turner claims as false or pants on fire, including COVID bioweapon theories and election fraud conspiracies. Even in his own December 28, 2025 post making these explosive claims, Turner himself wrote, "I have no confirmation yet." The original source admitted he couldn't verify his own story, yet thousands of people shared it as fact. A single unreliable source makes an unverified claim. Communities predisposed to believe it amplified the message, and by the time official denials come out, especially during holiday weekends, the false narrative has already embedded itself in thousands of minds. That's how misinformation spreads in 2025. What should exist if these claims were true tells us everything, and what's actually missing confirms the fabrication. First, the alleged $4.8 billion loss. According to the rumors, this came from a fake 8K filing from December 27, and an 8K is an SEC form that publicly traded companies must file within 4 business days of any material corporate event, things like major acquisitions, executive changes, or catastrophic financial losses. No such filing exists. You can check this yourself on the SEC's EDGAR database, which contains every public filing from every US corporation, and there is no JP Morgan 8K from late December 2025 reporting any silver-related losses. JP Morgan's actual financial performance tells a completely different story. In the third quarter of 2024, JP Morgan posted net income of $12.9 billion with no commodities losses reported, while in the fourth quarter of 2024, they posted $14 billion in net income with their markets division revenue up 21% year over year. For the full year 2024, JP Morgan reported record annual net income of $58.5 billion. Does that sound like a company about to collapse from a $4.8 billion silver loss? The only documented securities losses in 2024 filings totaled $546 million in net investment securities, and that wasn't even commodity specific, which means it's less than 1/10 of the claimed figure. Bloomberg, Reuters, and the Wall Street Journal published 0 reports of JP Morgan distress, while the FDIC announced no bank seizures and the CME Group confirmed only standard margin adjustments. When something truly catastrophic happens to a major US bank, it doesn't stay secret for even a few hours. Remember the Silicon Valley Bank collapse in March 2023? The entire financial world knew within hours because it was real and documented. The emergency Federal Reserve meeting claim should be the easiest to verify because the Federal Reserve publishes its complete meeting schedule publicly. The Federal Reserve's official calendar shows no unscheduled FOMC meetings occurred in 2024 or 2025. 0. The last actual emergency Fed meetings were during the COVID crisis in March 2020, when rates were cut 50 basis points on March 3rd and another 100 basis points on March 15th, and those were genuine crises requiring immediate action. Some versions of the rumor pointed to a routine Board of Governors closed meeting on April 7th, 2025, claiming it was emergency, but the Fed's own documentation states its purpose was review and determination by the Board of Governors of the advance and discount rates to be charged by the Federal Reserve banks. That's bureaucratic language for a standard administrative procedure that happens regularly. No rate changes resulted, no emergency was declared, and the meeting was completely normal. Elevated repo facility usage around $26 billion over the weekend got referenced as evidence of emergency intervention, but financial analysts noted this was not unprecedented, routine for year-end liquidity management, volatility, or regulatory flows, not proof of a specific silver-related bailout. Federal Reserve emergency meetings get announced, they get documented, they result in policy actions, and they generate immediate news coverage. None of that happened because no emergency meeting occurred. While the December 2025 bankruptcy claims are fabricated, JP Morgan absolutely does have a documented and verified history of precious metals, market misconduct, and here's where we need to be careful and honest. In 2020, JP Morgan paid $920 million to settle charges of precious metals market manipulation, fully verified by CFTC Press Release 8260-20 and Department of Justice records. Between 2008 and 2016, JP Morgan traders executed hundreds of thousands of spoof orders in precious metals futures. Spoofing happens when traders place orders they intend to cancel before execution to create false impressions of supply or demand, manipulating prices. It's illegal market manipulation, and JP Morgan did it systematically for 8 years. The $920.2 million penalty was the largest ever imposed by the CFTC, and it included $436 million in civil penalties, $312 million in victim restitution, and $172 million in disgorgement. Several traders received criminal sentences, with Managing Director Michael Nowak getting 1 year and 1 day in prison, while Executive Director Greg Smith received 2 years. The DOJ dismissed the case in March 2024 after JP Morgan completed its 3-year deferred prosecution agreement, which means they fulfilled the terms of their settlement. JP Morgan also maintains significant silver market infrastructure, operating a COMEX silver vault since 2011 and serving as custodian for the iShares SLV ETF, one of the largest silver investment products. Claims that JP Morgan flipped from a 200 million ounce short position to a 750 million ounce long position remain unverified speculation, and Sprott Money, a precious metals dealer, explicitly debunked these figures by stating, "The CFTC doesn't report specific positions, and no bank will ever come out and tell you directly what they're doing." This is the complexity we need to navigate. JP Morgan has a real history of silver market misconduct, which makes conspiracy theories about them sound plausible. But we can't let past verified crimes lead us to accept present unverified claims. Each accusation requires its own evidence. The bankruptcy story is fake, but so many people believed it because the claims were grafted onto genuine and extraordinary silver market conditions that have generated intense interest and speculation. Silver prices have surged approximately 120 to 150% in 2025, and that's not a typo. Silver has more than doubled in 1 year, reaching approximately $71 per ounce by late December 2025, up from around $30 at the year's start. This represents only the third time in 50 years that silver has peaked at this level. And to put this in perspective, the first was the Hunt Brothers Corner in 1980, while the second was the debt ceiling crisis in 2011. Major silver price explosions are rare, once-in-a-generation events that attract enormous attention and speculation when they happen. October 2025 saw a documented short squeeze, a real market event where short sellers scrambling to cover positions drive prices even higher. On October 9, 2025, silver broke $50 per ounce for the first time since 1980, while 1-month lease rates in London spiked to 39% versus the normal 0.3 to 0.5%. Overnight borrowing costs briefly hit 200% annualized, according to Rona O'Connell at StoneX. A 1,000-ton order from India reportedly triggered what followed, causing a freeze in London trading. When someone tries to acquire that much physical silver in a tight market, immediate supply pressure results. The market is tight, and the Silver Institute's World Silver Survey 2025 documents 5 consecutive years of supply deficits. The cumulative shortfall totals approximately 800 million ounces, which equals 10 months of global mine production, just vanishing into industrial applications and investment demand. Industrial fabrication hit records at 680.5 million ounces in 2024, driven by solar panel and electric vehicle demand, and silver is now fundamental for green energy transition. Solar panels require silver for their electrical conductivity, while electric vehicles use significantly more silver than traditional cars, creating structural industrial demand that won't disappear. LBMA London vault inventories tell the same story, falling from 35,667 metric tons in April 2020 to approximately 22,126 tons by March 2025. That's a 33% decline in physical silver stored in the world's largest precious metals hub. TD Securities warned that LBMA stockpiles could deplete within 7 months. And that's not a conspiracy theory, but a major bank analyzing physical inventories and making projections. Silver markets are genuinely experiencing extraordinary conditions, and this is the critical context. Supply deficits are real, price increases are documented, and industrial demand is at record highs. When legitimate volatility creates uncertainty, false narratives find fertile ground. The December 2025 rumors followed a recognizable pattern, taking individual verified facts and twisting them into an elaborate but unsupported narrative. JP Morgan paid a $920 million fine in 2020, a verified fact that became distorted into proof of ongoing manipulation and imminent collapse. Silver prices surged 120% plus, a real surge that got framed as evidence of imminent bank collapse rather than market fundamentals. Repo facility usage was elevated during year-end, routine liquidity management that got labeled an emergency Fed bailout. CME raised margins on silver futures as standard risk management during volatility, but this got portrayed as a panic response to JP Morgan losses. JP Morgan holds significant silver positions, a documented reality that got exaggerated into 750 million ounce conspiracy claims with no documentation. This is the anatomy of financial misinformation. You take real events, real institutions with checkered pasts, and real market volatility, then you add unverified claims that connect them into a dramatic narrative. The individual ingredients are factual, but the recipe produces fiction. One analysis summarized it perfectly by noting, "This episode underscores how sentiment drives markets more than facts in thin holiday trading, as a rumor from fringe sources snowballed into viral panic." Timing was also critical here. DC Report contacted 5 JP Morgan spokespeople on Sunday afternoon and received no reply, and during holiday weekends, official communications channels are slower. That delay allows speculation to fill the information vacuum, and by the time official denials came out, thousands had already accepted the false narrative as truth. Conspiracy theories about silver manipulation aren't new, and they intensify during every major price rally following a predictable cycle. The template goes like this. Large banks, particularly JP Morgan, are supposedly suppressing silver prices through massive short positions. And when prices rise despite manipulation, it's framed as the manipulators losing control. Any regulatory action or unusual market activity gets interpreted as evidence of imminent collapse, and there's always a prediction that prices will soon explode to $100, $200, or even higher once the manipulation ends. These narratives persist because they contain kernels of truth. JP Morgan did manipulate precious metals markets and paid nearly $1 billion for it. Banks do have significant positions in commodities markets, and regulatory oversight has historically been insufficient. The leap from banks have manipulated markets in the past to this specific multi-billion-dollar loss happened this week requires evidence, and in this case, that evidence doesn't exist. Anyone interested in financial markets faces the challenge of developing the ability to separate legitimate concerns about market structure from fabricated stories about specific events. Both can't be true just because banks have behaved badly before. This episode reveals something about how financial information spreads in 2025, as we have parallel information ecosystems operating with different standards of evidence. Traditional financial journalism requires verification, official sources, and documented evidence in one ecosystem. Bloomberg, Reuters, and the Wall Street Journal didn't report the JP Morgan bankruptcy story because they couldn't verify it. And that's not bias, but baseline standards for factual reporting. Social media and alternative financial media operate in another ecosystem where viral claims spread based on plausibility and emotional resonance rather than documentation. Stories that confirm existing beliefs about corrupt banks and manipulated markets circulate rapidly regardless of evidence. Legitimate critiques of the financial system get discredited when they're mixed with fabricated claims, and that's the problem. Discussing genuine concerns about bank concentration in commodities markets or inadequate regulatory oversight becomes harder when you attach those concerns to fake bankruptcy stories that make the entire argument look unserious. This matters for individual investors making decisions with real money. During the December 2025 rumors, some people likely made trading decisions based on false information. Maybe buying silver expecting imminent supply crises or shorting JP Morgan expecting collapse. Those decisions had real financial consequences based on fabricated stories. The ability to verify claims through official sources matters more than ever. SEC Edgar for corporate filings, federalreserve.gov for Fed actions, established financial news outlets for breaking news. These are the tools that help you distinguish fact from fiction. Extraordinary claims require extraordinary evidence, not just viral Twitter threads from anonymous accounts. Let's bring this back to where we started. Claims that JP Morgan posted a $4.8 billion silver loss are fabricated, originating from a convicted conspiracy theorist who admitted he had no confirmation. No SEC filing exists, no credible financial outlet confirmed it. And JP Morgan's actual earnings show record profits. Claims of an emergency Federal Reserve meeting are false, with no unscheduled FOMC meeting occurring, and routine year-end operations were mischaracterized as emergency interventions. What remains true is this: JP Morgan has a verified history of precious metals manipulation, costing them $920 million in settlements, while silver markets have experienced genuine, extraordinary volatility in 2025, with prices more than doubling. Supply deficits are documented, industrial demand is at records, and the October 2025 short squeeze was real. Unreliable sources have exploited these facts to construct elaborate but unsupported narratives about imminent financial crises. And the December 2025 rumors follow a recognizable pattern where real market dynamics and historical misconduct provide the raw materials for fabricated stories. For anyone interested in financial markets, the lesson is clear: verify before you amplify. Check official sources, consider the credibility of where information originates, distinguish between documented events and speculation, and understand that past crimes by institutions don't automatically validate present claims without new evidence. Silver markets may well continue their extraordinary run, and structural supply deficits plus industrial demand could drive prices higher. Those are legitimate topics for analysis based on documented fundamentals, but that analysis needs to be grounded in facts we can verify, not viral rumors we want to believe. The next time you see a sensational claim about bank collapses or emergency government meetings, take a breath. Check the source, look for the official documentation, and ask whether credible outlets are reporting it. That discipline, separating signal from noise, is what protects you from making decisions based on fiction while missing the real opportunities and risks that actually exist in markets. The truth is often less dramatic than the conspiracy theories, but it's also more useful, and in financial markets, useful beats dramatic every single time.